the same spiritual source, so we have a lot of connections here. Thank you, Mr. Tunde, for coming. All right, so we'd like to have the welcome address by the President and Chairman of Council, as earlier mentioned, ably represented by very capable, competent Vice President, Sir Ladi Smith, FCA. Let's put down together for Sir Ladi Smith.
Good morning, ladies and gentlemen. It's my pleasure to be in your presence this morning at this forum. I was informed that the president, who should have been here, had a sudden engagement and couldn't attend this event today, and kindly asked that I should apologize for his absence. So I'm here, and I hope that you'll accept my presence to represent him here. Thank you very much. My name is Ladi Smith, and I'm a Vice President of the Lagos Chamber of Commerce. I do represent the Business Education Services Department. That's the best services department of the Lagos Chamber of Commerce. So my opening remarks on behalf of the President, Chairman of Council, Lagos Chamber of Commerce, Engineer Leye Kokpolui, at today's Maritime and Professional Practice Group Annual Joint Symposium themed The Nigerian Tax Law, Policies and Reforms Impact on the Maritime and Professional Services Organizations today. It's my honor to address this symposium at a pivotal moment in Nigeria's fiscal and trade reform journey. The ongoing tax reforms and trade facilitation initiatives represent a coordinated effort to modernize revenue administration, improve efficiency, and strengthen Nigeria's competitiveness as a regional trade hub. Nigeria's fiscal position is gradually improving, with the tax to GDP ratio rising to 13.5% as of September 2025, up from less than 10%. This reflects progress in revenue administration and compliance reforms, and this ratio is expected to rise further with the implementation of the new tax law. The law was designed not to increase the burden on existing taxpayers, but to expand the tax base and provide relief to low-income earners. The reform framework was strengthened in June 2025 through the enactment of the 4 key laws: the Nigerian Tax Act, which is called Fair Tax, the Nigerian Tax Administration Act, the Nigerian Revenue Services Establishment Act, and the Joint Revenue Board Establishment Act. Together, these laws aim to unify Nigeria's tax system, enhance coordination, and deepen digitization for improvement and transparency and efficiency of the tax system. Within the maritime sector, recent trade facilitation reforms, particularly the introduction of the National Single Window Initiative, represents a significant structural improvement in port efficiency. By integrating multiple regulatory and documentation processes into a unified digital platform, the National Single Window is expected to reduce cargo clearance time, minimize duplication of agency procedures, and lower transaction costs at the port. This reform directly addresses long-standing inefficiencies in Nigeria's port system and strengthens the competitiveness of our maritime trade corridor. When effectively implemented alongside tax harmonization efforts, it can significantly improve the ease of doing business in this sector. Despite these gains, the maritime sector continues to face high logistic costs driven by overlapping levies and administrative bottlenecks. The success of both the tax reforms and the National Single Window will depend on strong interagency coordination, digital integration, and disciplined execution to ensure that efficiency gains translate into measurable reductions in port costs and improved trade flows. In the professional services sector, which remains a key pillar of the Nigeria's knowledge economy, the new tax regime consolidates multiple tax levies into a more streamlined structure. While this improves clarity and administration, it also expands the tax base. The government has further clarified that essential items such as food, education, shared transportation, and agriculture will be VAT exempt, offering relief to households and supporting social balance. However, firms may experience transitional compliance pressures as digital reporting and disclosure requirements expand. The reform agenda offers clear opportunities to improve revenue mobilization, digital efficiency, and institutional transparency. However, risks remain around implementation capacity, policy coordination, and compliance burdens during the transition. Global experience shows that the success of such reforms depends more on execution quality than on legislation alone. For the maritime sector, the combined impact of the tax reforms and the national single window must translate into simplified processes, reduced charge duplications, and faster port clearance times. Professional services, policy predictability, and streamlined compliance systems, they remain quite critical. The maritime and professional services sectors remain central in this transformation. The LCCI remains committed to supporting reforms that deliver a more efficient, competitive, and investment-friendly Nigerian economy. I thank you all for listening, and I declare the event open. I wish you all Engineer Leye Kukboloyi. Thank you very much.
Once again, please put your hands together for the President representative. Thank you so much, sir, for a good representation this morning. On that note, having declared the event open with this welcome address, we'll go fully into what we have today. I mentioned the other time that the outgoing chairperson of the PPG is here, a woman that worked confidently on the path where some men fear to tread. Put your hands together for the opening remarks by the outgoing chairperson of PPG, Engineer Priska Carnaby. Please, let's clap for her, please.
Well, good morning, everyone. Good morning, my president and other members who are here. Actually, this event should have been held since last year. Probably that is why it's calling me the outgoing, because today also is the day I'll officially hand over to the current chairperson for the professional practice group. So having said that, I want to say I'm delighted to welcome you to this symposium that was put together between our sectorial group and that of the Maritime Sectorial Group of the Lagos Chamber of Commerce and Industry. And it's wonderful to see so many persons participate and other professional colleagues here today. Before we get started, I would like to express my sincere gratitude and appreciation to the persons who put this together, Mrs. Fumi, Mr. Bimbola, and many others. Apologies, please. I just missed my... Okay, I'm back there. Without you, we couldn't have had this event. We've had back and forth trying to agree on how to go about the symposium, and I'm hoping that by the end of today, we'll all leave here well-informed and better. Today, we'll be discussing the Nigerian tax law, policies, reform, impact on the maritime and professional practice organizations. And we have experts here to take us through these reforms on how they impact on our businesses. I would like to share my sincere gratitude to our sponsor, Deloitte, whose support made this event possible, and also to our keynote speaker, who bring invaluable expertise to our discussions today. But most importantly, all of you for being here. We have a packed agenda designed to inspire, so I encourage you to please participate fully. Thank you once again for joining us, and I hope you have a productive session with us today. Once again, I say thank you very much.
Thank you so much, Engineer Priska. I was thinking you were still going to take time, you know, but it's fine. Yeah, I mean, the shorter the better. All right, thank you so much. So we'll dive into major talk today as we have our keynote speaker address us. I told you the keynote speaker, Mr. Abdullahi Saliu, Director of Shipping Development NIMASA, is represented here this morning by Mr. Obaya Joshua. Please make welcome Obaya Joshua, Technical Advisor, Director of Shipping, for the keynote speech. Let's clap for Mr. Obaya, please.
Good morning, everyone. My name is Obayan Joshua. I'm the Special Advisor to the Director of Shipping on Technical Affairs, and I count it a great privilege to be here this morning. I also want to thank the Lagos Chamber of Commerce and Industry for organizing events such as this that allow Nigerian stakeholders come together and tackle critical issues. So let me jump in and deliver Mr. Yolowa's keynote address. Please permit me to stand on all existing protocols. With recent shift in Nigerian physical landscape and introduction of digitized tax systems taking effect, a lot of questions have emerged on the implications these tax reforms have to the Nigerian transport and logistics sector, and how the perceived opportunities stemming from the modernized tax regime can be harnessed by Nigerian operators. Before proceeding, I must acknowledge the Director General NIMASA, Dr. Daya Mobriola, and the executive management, whose mandate and continuous support for industrial collaboration have paved the way for my presence here today. As a maritime nation, the evolution of our physical environment presents an important opportunity for the Nigerian shipping industry, as the envisaged growth in digital transparency across the sector provides a platform for shipping operators to compete favorably and attract the necessary foreign direct investment. In the past, issues surrounding ambiguous compliance frameworks, manual audits, and the lack of alignment between regulators and businesses have served as militating factors which have affected the ability of indigenous operators to partake and grow competency in international trade. Furthermore, the sudden transition to real-time transaction reporting has left the segment of the industry exposed to operational shocks, as operators largely dependent on capital-intensive asset maintenance, cross-border transactions, and legacy accounting systems. For the Nigerian maritime sector to experience its much-needed economic renaissance, there has to be collaboration across the industry, taking advantage of the expertise of professional services under the holistic structure to deliberately ensure that as an ecosystem we seamlessly navigate these regulatory gray areas. Therefore, the importance of a future-ready tax strategy cannot be understated, as it presents operators a route to sustainable economic prosperity through planned, proactive compliance, thereby developing internal fiscal transparency. So the question remains, how do we as an industry prepare ourselves to tap into the vast opportunities made available from the implementation of these fiscal reforms while mitigating the immediate burdens? The availability of skilled tax professionals and auditors within the LCCI, as well as the present push for digitalization, paint an exciting picture for the country, as Nigeria will be seen as a viable location for investment due to the changing operational dynamics that will be created as a result of transparent tax reporting. The availability of, while NIMASA is fundamentally recognized as the apex regulator for maritime safety, security, and administration in Nigeria, it is imperative to state that our core mandate extends far beyond mere regulation. It is deeply inherently dipped in promotional activities. Under the guiding framework of the Ministry of Marine and Blue Economy, we are actively tasked with the development of indigenous shipping capacity, the facilitation of maritime trade, and the creation of an enabling environment for Nigerian operators to thrive. However, we recognize that fundamentally, this promotional mandate cannot be realized in a vacuum. You cannot build a robust competitive shipping fleet or attract sustainable foreign direct investment in an unpredictable and overly burdensome fiscal environment. In turn, the increase in digital transparency resulting from internal initiatives like the electronic maritime monitoring system, combined with the existence of favorable government policies supporting the local transportation of logistics industry, will culminate in the situation where Nigerian shipping operators will be given the much needed edge to compete with foreign counterparts in international trade. Truly, a modernized, predictable tax regime offers a lot of promise to the Nigerian industry and for Nigerians. A step forward for the nation, edging us ever closer to the fulfillment of our economic potentials within the marine and blue economy. However, the journey has just begun, and a lot of work still remains to ensure that as a nation we take full advantage of the benefits these reforms have to offer us, particularly by ensuring that the maritime tax and levies promote fleet expansion rather than capital flight. It is my hope that the presentations and deliberations of today take us ever closer to the finish line as we seek a clear path in the implementation of a future-ready tax framework with the view of taking Nigeria and her people to new heights of economic prosperity. Thank you.
Once again, thank you so much, Mr. Joseph. Let's put hands together for him, Joshua. Thank you, sir. All right. I'm sure we're all waiting for the next opening remark by the co-chairperson of the groups organizing this today. Please, with all joy, put your hands together for Mrs. Fumi Folorunsho for our opening remark, chairperson of the Maritime Group here at SCCI. Let's keep clapping until she comes up here, ma. Thank you. Thank you, ma. Last week, our event also was holding here, but while she was with us in Gambia or somewhere, Angola, yes, please. But she's here with us today in Nigeria, particularly in Lagos. Put your hands together for her.
On behalf of the Maritime Group of LCCI, I want to welcome the maritime industry here present and those online. I want to express my sincere appreciations through Sir Smith to the LCCI president. From inception of his administration, the LCCI president has made it very clear about his passion for the maritime industry. And through Sir Smith, I want to say thank you to him for his support and guidance behind the scenes. I want to appreciate Engineer Priska. Thank you. You know that is loaded. I want to express my appreciation to Nemasa for your expression. And I want to bring it to your attention that we have underlined it. You have appreciated that LCCI, within LCCI, we have a body of tax professionals. Nemasa working with LCCI on the issues of tax reforms and its effects within the maritime industry is key. I have spoken to you, and I believe we'll be paying a courtesy call on the DG Nemasa shortly to see areas of mutual cooperation. Whatever you want within the Nigerian economy resides within the LCCI. Professional group, banking, finance, whatever is here. We look forward to a partnership with you. Please clap for Nemasa, our incoming member of the Maritime Group. Yes, that's our message to you. Distinguished audience, tax cuts across all sectors of the economy. It affects the bread seller, it affects the maritime industry. The maritime industry cuts across every sector of the economy. And that's why, unlike Mr. Smith, who believes his sector is the most important, Maritime Sector Group, we are the most important. Please clap for our sector. The maritime sector, more particularly, is affected by these tax reforms. Let me give you a benefit of something that happened when I was younger. Customs woke up one day and said, ship owners in Nigeria, you haven't paid custom duties for your vessels. Those you imported 20 years ago, 5 years ago, that was their revenue drive. How do you ask us to pay customs duty for a vessel in operation that we had imported 10 years ago with depleting numbers? It was a tug of war. But to God be the glory. We made a case, and the ministry, the finance minister, understood what that single decision was going to mean to the industry maritime. The tax reforms we're going to be talking about this morning, it affects the ships. Legal persons here present know that the ship itself is a person, and therefore you go to the High Court and you say, MV vessel, blah, 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 is first defendant or whatever. The tax reforms we're talking about affects the ship owner. The tax reforms affects the shipping service providers. On Monday, LCCI was privileged to sit with the House Committee on Shipping Services. And we hope that the outcomes will assist the country rather than cause more problems for the country. Therefore, this event becomes very important to our industry. A few days ago, we were here at the Maritime Breakfast. Today, we are here talking tax reforms. And I can assure you, I recognize the presence of an executive member of the Maritime Group, my learned silk, Dr. Akabogu. And it is our privilege to announce to you that the Maritime Group will continually have deeper engagements. This is just the beginning for tax issues because of the way it affects us. Look forward to our invitation. We promise as a group to work with all other sectoral groups of LCCI and with the maritime industry. But I look forward to a serious engagement of what I personally see, as you have not taken the maritime industry into consideration in these beautiful tax reforms presented. We need to present our case. Thank you for coming, and do have a good time here.
Thank you so much, ma. I think I'm taken aback this morning with very short remarks. I went to pick my phone, and before I can say Jesus is Lord, chairperson was already done with her speech. That's fine. On that note, before we move into the main thing, I'd like you all to take a group photograph for the press. Let me ask that the representative of the president please step out. Mr. Vice President Lady Smith, joined by the two chairpersons of the group, as well as the technical advisor, director of shipping, Nimasa, Mr. Obaya. Joshua, let's use this split, yes. Yes, I think this is better. Please, let's have Dr. Kabogu join us. I'm told he's around. So, Dr. Kabogu here, yes, that looks balanced. No, we'll take it in groups. We'll take it in groups, man. I'll call you, I'll join. Ma, we'll take it in groups. You will join in the next one. I needed this picture for a particular purpose. Just don't go too far. Don't go too far. Yes. Are you good? Please, let's have Mrs. Akimola to join them. Thereafter, we'll have the speakers and panelists also join us. Are we good? Let's have the panelists please join us. Let me have my list. We have Foluke joined. Please let's have Shukuka Ikwazum, SAN. Please let's join us. Sorry, and I got the first one well. Let's have, which is from Alukon Oyebode, represented by Agada S. Agada, manage. Agbada. Oh, Agbada. I wish I come with my Agbada today. Let's have Dr. Emeka Akabo. Okay, Emeka Akabo is with us already, SAN. Celestina Nwabueze, please let's join. Is it in? So let's have this before we have Deloitte join us. All right, let's have Mr. Olukunle Ogunbanwo, task partner Deloitte. Please let's join. Thank you. After this, we have the incoming PPG chairperson join us. Mrs. Taiwo Afonja, I'm told. Let's have Mrs. Afonja join us. Okay. Miss, okay, thank you. See, now my list is growing by the day. Right. The speaker, please, let's join. Please, let's join, sir. I had already called him much earlier. I did. Sorry, sir. Apologies. Thank you. Thank you so much. Thank you, everyone. Thank you. All right. For the guest speaker's address, is represented here today by Mr. Killian, senior partner at Creston Padebo, right? Let's put hands for Killian as he makes his address. Please, we are not clapping enough for him. Is it because he's on suit? He didn't put on a Milocon cap. Thank you, sir.
Thank you. Yeah. The president of the Lagos Chamber of Commerce and Industry, ably represented by a very senior colleague in my profession, Mr. Ladi Smith, all the chairpersons of the sectoral groups here present, fellow speakers and panelists at this event, ladies and gentlemen, good morning. Yeah, I'm representing my managing consultant and partner at Creston Pedabo, Mr. Albert Foloronshaw, to deliver his address and make his presentation. Mr. Foloronshaw was supposed to be here. Unfortunately, this event was rescheduled, and today now clashed with another event that he has to be at outside the country. And so your misfortune is my fortune. Thank you very much. I would just jump straight into the presentation. So, yeah. So this is like a summary of everything we'll be talking about this morning, and it's on these 4 pillars. First is the fact that we must come to terms with the realization that Nigeria is transitioning to a digital tax administration system. And I think the president's address this morning laid that foundation and made that very clear. And so the way it is, the NRS is clearly making progress in its efforts to ensure that tax administration becomes digitalized in Nigeria. The second pillar of this conversation is the fact that this transitioning is anchored also on the implementation of the e-invoicing system by the NRS. And the intention of that, of course, is to ensure that all transactions, at least most of the transactions that are carried out in the formal sector, are clearly within the view of the tax authority. The third anchor of this conversation is that as businesses, we must all prepare for mandatory compliance. We really do not have a choice. And so while we realize that this is coming to be, we need to begin to ask ourselves, how ready are we? And on that note, I want to thank the organizers of this event this morning for playing their role in educating not just its members, but other members of the public who should be interested in this. Fourth is the fact that enforcement is set to begin this month, all things being equal. And I'm saying all things being equal because enforcement had previously been slated for an earlier date, but it was shifted in realization of the state of readiness, both of the tax administrators and of the taxpayers itself. So, are we ready? If we are not ready, what are the consequences for not being ready? We will see all of that in a brief moment. I've forget that this is with me. Okay. Let me give you the background. In July 2025, the Nigeria Revenue Service, which used to be known as the Federal Revenue Service, introduced the e-invoicing regime. And this regime mandates all taxpayers defined as entities with an annual turnover of 5 billion naira and above to adopt the electronic fiscal system through the NRS merchant buyers solution. Affected taxpayers were required to fully implement the electronic fiscal system by 1st August 2025 and to integrate their invoicing systems with the NRS to enable real-time invoice transmission and validation. In recognition of the technical challenges businesses faced, the NRS subsequently extended the compliance deadline to 1st November. So initially, compliance was supposed to have been in August. It was shifted to 1st November, and subsequently again shifted to January. But it is expected that those people who were supposed to have implemented should have implemented by now. Now, the implementation itself is backed by critical provisions within the law. And I think in his address, the president had mentioned the fact that we have overhauled our tax laws. Section 157 of the Nigerian Tax Act and Section 23 of the Nigerian Tax Administration Act 2025. Together, these provisions signal a definitive shift to real-time digital enforcement of VAT through what the law calls fiscalization. What does this mean in simple terms? It means every VATable invoice your business generates. In fact, let me correct that. Every invoice, whether VATable or non-VATable, your business generates will now be transmitted to the NRS in real time for validation. The days of filing VAT returns months after the fact with limited verification are coming to an end with the full implementation of the e-invoicing system. The legal framework. Let us look at the law itself. Section 157 of the Nigerian Tax Act states, and I quote the key provisions: a taxable person making a taxable supply shall implement the fiscalization system deployed by the service in accordance with the Nigerian Tax Administration Act. End quote. The word shall is important. This is not discretionary. It is a legal obligation. Subsection 2 of the same section 157 then defines what the fiscalization system may include. It says it may include fiscal equipment consisting of electronic devices, software solutions, or a communication system involving a secured network or any such combination of these components for electronic invoicing and data transfer, as the service may prescribe or deploy. What this means is that the NRS has been given wide legislative authority to determine the technology, the format, and the method of deployment. And they have exercised that authority by deploying the merchant buying system. Now, let us turn to section 23 of the Act. I think I'm a little bit, I don't know whether fast now, yeah. This is the operational backbone. Subsection 1 says, where the service deploys an EFS, which is the electronic fiscal system, any person making a taxable supply shall use the EFS for recording and reporting all supplies. Subsection 2 places the responsibility squarely on the taxpayer. Okay? Tax taxable persons shall be responsible for maintaining accurate records of all transactions passing through the AFS. It is not the responsibility of the NRS to maintain the records. So it's important to understand this. While you are transmitting your transactions through the system, you still have the responsibility of maintaining the records, at least the backup of the records of those transactions that have gone through the system. And why this is important is the fact that an electronic or a digital tax administration system ought to make it easier for audits to be conducted, ought to make it easier for reconciliations to be carried out. You cannot use the excuse that your transactions have already passed through the system to refuse to provide documents and records to the tax authority when they ask for them. So the responsibility to maintain appropriate and adequate records still lies on the business. Subsection 3 says the service shall specify the fiscalization system to be adopted and a transition arrangement for its implementation. This is the legal basis for the phased rollout, which we will see very shortly. Subsection 4 says the service shall issue regulations to give effect to these provisions. We have seen publications. I don't know whether we'll call those regulations, but we do know that since the passing of the tax laws, the NRS has been working on some of these regulations and circulars, which we are expecting to be released soon so that we can all be properly guided. But in advance of that, they have made several publications and they've been holding stakeholder events to educate people and to sensitize the general public towards the implementation of this. Now, the penalty for not complying, Section 104 of the same act provides that a person who fails to process a taxable supply through the fiscal system is liable to an administrative penalty of 200,000 naira plus 100% of the tax due plus interest at the prevailing Central Bank of Nigeria monetary policy rate per annum. So the fact that you didn't process the transaction through the system does not exempt you from paying the tax. You will still have to pay that tax when you are caught, but you will pay a penalty of 200,000 naira plus interest at the prevailing NPR rate as will be notified by the CBN from time to time on an annual basis. And for those of us who have dealt with the NRS recently in the last year or two, either as consultants or as companies, you will realize that default for tax payment or early tax payment become much more penalized. The measures are more, the punitive measures are more stringent now. Penalties sometimes outstrip the real tax that should have been paid that was not paid when it was supposed to have been paid. And so this still affects your non-implementation of the e-invoicing system. E-invoicing is not novel, though novel to Nigeria, but it's something that is already been implemented or at various stages in different countries. Benin Republic commenced their implementation as far back as 2020. Ghana is at a stage of their own implementation. Niger, and so many countries across Africa. So we are not totally in a special place. Some people actually expected that we should have commenced implementation a lot earlier than now. How does this system work? So it's a digital platform. and it's supposed to work on a real-time and online basis. But we'll just break it down briefly. When you generate an invoice, it is transmitted electronically to the NRS, validated, and returned with an invoice reference number, which is known as the IRN. And it comes with a cryptographic stamp that confirms its authenticity. This is important because at a later stage of implementation, even your customers will be expected to first confirm that that invoice has been pre-authenticated by the NRS before they are allowed to pay you. So, and it is only when this invoice goes through this system before it can have that authentication and it can be verified by the customer for payment. The system integrates with your existing business ERP or accounting system. So you don't have to abandon the system that you already have in place. Your current invoice infrastructure can still continue to be in use. All you just need to do is to integrate it with what the NRS has implemented. I see you have some interested parties in this room. I was approached earlier by somebody who is offering this service. Now, it covers all three transaction types. You know, whether it's a B2B transaction, it's a, business to government, or you are dealing with retail customers, whatever kind of transaction you are doing is taken care of by this system. Now, what are the compliance requirements? Key compliance requirements include, first, you have to integrate. You need to connect your ERP to the NRS MBS. Now, the question of sometimes, which we'll deal with later, is supposing I don't have an ERP, what do I do? I'm sure we'll address that in a short while. Second is the invoice clearance. This is where the process differs depending on your transaction type. For business to business and business to government transactions, your invoices must be cleared by the NRS before you can issue them. So there are some situations where, not very common from our experience so far, where the NRS system is down, then you are not able to generate an invoice because they cannot be authenticated. Okay, but I think there's a way around that also that enables your integrator to be able to generate that number for you and subsequently communicate it with the NRS system when it comes up. So it is not like the electronic transmission of result problem that we are not able to do. For business to consumers, that is where it's a little bit different. And we are looking at transactions like the sales of a supermarket, for example, the sales of a hotel or a restaurant. You know, sometimes the values are small, the volumes are very high. In such situations, they don't have to be necessarily issued on a real-time basis. You have up to 24 hours to transmit such kind of invoices. Typically, because of the volume, they are done in batches, unlike the B2B or B2G transactions. In practical terms, just think of it as if the NRS is sitting in the middle of every invoice your business issues, verifying it on a real-time basis. So the NRS is right in your office, so to speak. It's seeing the money coming and going. It's seeing your debtors. It's seeing those people who you are owing ultimately. So it's just a matter of reconciling positions when the time comes. Now, timelines have been given by the NRS, as you can see here on the screen. First is the large taxpayers who have already been who are expected to have complied, and enforcement will start this month. So penalties can be issued by NRS for any invoices that are generated outside the system from this month. But because they are given a whole quarter of a year, it means that they may still allow you some time to implement within these last 3 months. Then the medium taxpayers above 1 billion naira are expected to comply by the end of November, and by January to March, enforcement will be implemented against them, as well as the emerging taxpayers who are the small taxpayers that are generating below 1 billion naira. They will be expected to also comply in the last quarter of 2027. Now, what are the implications for our businesses? The implications are very clear. First is the fact that we must upgrade our systems to ensure that they can work with the NRS system. We need to have training for both our finance people, our procurement people, and of course our IT people on how this system works, so that we can properly implement it in our various organizations. We may have to redesign our systems. And when I mean systems, I'm not talking just about our IT system. Even the system that we use to raise invoices, including our internal audit system, to ensure that all the processes that we are used to having are amended to recognize that in addition to what we were doing before, we must ensure that our invoices are properly processed through the NRS system. And this is important because there is a financial cost for not doing it. And as businesses we are in business to make profits, and we don't want to give away any of that profit to the government where we think they do not deserve it. So why pay the penalty when you can incur just a little more cost to ensure that you do the right thing? So we already know what the risk for non-compliance is, so I would probably not go too much into that. But non-compliance raises red flag. We know that. Interestingly, the tax authority can actually see all your transactions that flow through the bank. So they know whether you are already earning above 5 billion. At least they have an idea. Now, and yet they go through the MBS, and they are not seeing your invoices. Automatically, that's a red flag, and it won't be a big surprise when they come knocking at your door and asking you why you have not yet run your invoices through their system. And typically, audits will follow, penalties will come, your operations will be disrupted. Not that you can totally avoid audits, but an audit that you are prepared for is always easier than the one that you are not prepared for. Now, what are the implications for our businesses? This is very key. It means, first and foremost, we are more ready for our audits. We are more prepared for, we can report our VAT more accurately than we probably were doing before. Because the way the system works, you not necessarily have to pay the VAT upon issuing the invoice. You pay the VAT after the invoice has been paid. You know, sometimes people will worry, okay, supposing the invoice has not been accepted by the customer, or it has not been or it is subsequently disputed, there are there are ways to work around that, even on the NRS system. You can issue credit notes on the same system that will indicate a cancellation of an earlier invoice that you have issued. So it's robust enough to take care of all of those accounting challenges. But key thing is, if I'm seeing what you are doing, you know that I am seeing what you are doing. Trust is expected to be enhanced. The basis for arguments are supposed to be limited. But for the government, yes, it aligns with Nigeria's digital economy goals, which we have been touting for so many years. It's a good thing that at least we are beginning to take steps towards implementation. Now, specifically for the maritime industry, I expect that this should even help. Okay, I'm currently helping to resolve an audit for one of my shipping clients. And one big challenge we are having is the fact that the invoicing system is so robust. A lot of invoices are generated on a daily basis. Now, reconciling this data with the tax authority is, in fact, it's a nightmare. And the way the tax authority wants the information, they want it in very simplistic terms that are not the same terms and format that is used to keep those records. So they find it hard to understand it. Okay? I think that would not be the situation if I'm issuing those invoices on his platform. So his platform, he can download the data from his platform. He can sort it the way he wants to understand it, and all we simply need to do is to compare notes. So especially for companies in the shipping business, I expect that this will truly impact on them on a more positive note than otherwise. There is also expectation that the e-invoicing system will also be integrated with the customs platforms, which means that the entire value chain, and if you remember that NRS is now the sole revenue collector for government. So it's expected that even customs transactions will be going through a system to which NRS has a direct view. So integrating it with these will be very helpful. But the last point is the one I really want us to understand. Because you are being invoiced, you are also invoicing. As people are invoicing you, they are charging you VAT. And under the new VAT law, all VAT can now be refunded or claimed or deducted from the output VAT that you pay from the output VAT that you collect as a business. But if your VAT payments cannot be traced to the system, then they will not be refunded or offset from your output VAT. So it's actually a win for businesses in that regard. And for professional service organizations, yes, the big issue is, yes, there is VAT issue there. There is also the issue of being able to account for even the withholding tax credits that are due to you. You are able to track that on this system. If you are issuing your invoices on this system, your clients are also approving those invoices on this system. The ability for you to track your withholding tax credits, for example, becomes a lot easier for you to do. Now, there are three methods, basically, for deployment of the invoicing system. The first option is the APP outsourcing. That is the access access points provider outsourcing. And this is the one that is typically used by businesses who do not generate large volumes of invoices. And who also do not have an ERP system. So they simply work with an outsourced service provider to generate their invoices on that platform before using their own internal invoice system, so that they can take the the IRN number that has been issued by the NRS and impute it on whatever invoice system that they already have before they can send to their client. That way, they have been able to meet the requirements of the law with respect to e-invoicing. This is what we recommend to professional service firms who do not do large volume transactions, but even though the transactions can be large values. The second option is the system integration. And this is the one that is more suitable for companies that do large volume transactions and who also have an ERP system. So you simply integrate your system with the NRS system, and everything you do in terms of invoicing can report online real time into the NRS MBS. There is a third option, which is, oh, did I miss that out? There's actually a third option. Wow, so sorry. There's a third option that is known as the middleware. And the middleware is simply used by companies who don't want to directly integrate with the NRS system. We've seen a lot of companies complain about that. They will say, oh, we don't really trust how Nigerian government will tell you that they want to plug into your system, and they begin to see things that you don't want them to see. So instead, they implement what they call a middleware that acts as an interface between your ERP and the NRS system, such that it is only the aspects that at least you are confident is going to the middleware that goes to them. But still, it captures everything that is expected to be captured. In conclusion, the e-invoicing mandate is a transformational shift, of course, and we definitely should see it as an opportunity and not just as a compliance burden. We should look at the good sides also. Therefore, businesses must act now to avoid disruption to their operations when enforcement commences. As the NRS steps towards compliance, you should conduct your system readiness assessment. Engage professional advisors to guide your implementation. Train your finance and IT teams. Comply with the law and avoid incurring avoidable penalties. On this note, I want to thank you sincerely for your attention.
Thank you so much, sir. Please, let's put hands together once again for Mr. Killian. You agree with me that the presentation very lucid, no confusion, but I believe we have conversation around some questions and answer when we get to that session. But quickly, we need to move to what is next, which is from our proud sponsor, Deloitte. Let's have Mr. Olukunle Ogunbanwo, task partner at Deloitte. Let's put hands together for Mr. Olukunle. Let's clap for him so well, please.
Can we have it up, please? Okay. Good morning. Good morning, everybody. Please permit me to stand on the existing protocols so that I won't offend anybody. My name is Kunle Ugubambowo. We just want to talk about, again, future-ready tax strategies, preparing the maritime and professional services firms for the reform-driven change. So, I'm going to be looking a bit more broadly at how the tax reforms affect these two sectors. We just had Killian talk so succinctly about e-invoicing and what we need to do. Here we'll look a bit more broadly about the tax reforms and specifically how it affects these two sectors. So what are we talking about today? Just a quick overview of what the reforms entails. We look at some of the changes that's introduced by these new tax laws. What are the considerations for the maritime companies? What are the opportunities? And what are the tax strategies that those of you that are operating within the maritime sector can begin to consider? We'll do the same thing for the professional services firms, and I'll just leave you with some concluding thoughts. Okay. So, essentially, when we talk about the Nigerian tax reforms, essentially we are talking about 4 new tax laws that were passed in June, around May, June of last year. They took effect from January 1st this year. What are those 4 new laws? The Nigerian Tax Act, which contains the taxing production. So the Nigerian Tax Act is the act that imposes tax on any kind of income profit activities within Nigeria. So in the past, we used to have different tax laws talking about different aspects of taxation and all that. It was a bit confusing because companies or taxpayers sometimes found it difficult to even keep track of what their obligations are because those obligations are contained in numerous legislation. But now, all those have been consolidated into one, the Nigerian Tax Act. That's what it talks about. Then we have the other one, the Nigerian Tax Administration Act, which just talks about how tax will be administered within Nigeria. This is also the act that talks about issues around assessment, tax audits, procedures, penalties, and all that. Administration matters generally is contained within that law. We have the third one, which is the Joint Revenue Board Act. This act establishes what we used to call the Joint Tax Board. It's now called Joint Revenue Board. It establishes the tax ombudsman and also sets up around tax appeal tribunals, how appeals will take place and all that. And the fourth act that was enacted was the Nigerian Revenue Service Act, which replaces FRS Establishment Act, and then set up Nigerian Revenue Service to replace the defunct FIRS. So, what are the reasons, what are the general strategic thrusts for these reforms? First, Nigeria is seeking to increase its tax to GDP ratio. The first time I heard about tax to GDP ratio when they released to Nigeria was when Madam Adeosun was the finance minister, and she said Nigeria tax to GDP ratio was around that time about 6% or less than that. Nigeria had one of the least tax to GDP ratios, even within sub-Saharan Africa. The objective is to increase that progressively over time. I think I said last year, the ratio stood at about 13%. The objective is to increase it to about 18% before the end of next year. There are some taxes that in the law where we can say maybe we are taxing poverty, and I'll explain. So if you look at the vulnerable sectors of the economy, those that are within the very last layer of the curve, in terms of income capacity and all that, the laws, as we used to have them, they didn't kind of think to protect them. For instance, every single organization was required to charge and pay VAT. Every single organization was required to pay tax. And in fact, companies that are making losses were required to pay tax as long as you are making income. Now, if you say the compensation tax is a tax on profits, then why are you taxing a company that's making losses? So some of these things have been fixed. So in terms of shifting the focus of taxation from the poor from the have-nots to the haves, I think these law reforms have done a fantastic job at that. We want to reduce the incidence of tax evasion. Killian spoke about penalties when it comes to issues around e-invoicing. Now, there are stiffer penalties really in the law for other aspects of compliance. So the government is hoping that if they impose stiff penalties for non-compliance becomes more expensive than compliance, then taxpayers are more incentivized to comply. There's an objective to reduce multiple taxations and reduce multiple agencies. For instance, NRS is now the single agency of the federal government that is responsible for collecting all revenues according to the federal government, rather than in the past where we had different agencies responsible for different types of taxes. We had multiple laws, including that has provisions to tax organizations and taxpayers. So we're trying to eliminate that as well. There should be clearer rules for taxation, and then ultimately we are looking to have a current business practices reflective tax systems. So we had, our tax laws, some of our tax laws were older than when I was born. We had laws that were enacted years before I was born. And if you consider that business world is very dynamic, so the way businesses are structured today are completely different than the way they were done 40, 50 years ago. So it was important for us to modernize our laws to be in line with more recent business realities. So I think this reform seeks to address that as well. So what are some of the key changes? And I will just try to rush through this. We will spend a bit more time on maritime and produce services sectors. I spoke about the fact that we no longer have tax on turnover. That was the minimum tax rule that we used to have, where taxpayers within the corporate organizations had to pay minimum of 0.5% of the turnover as taxes, whether we are making profits or not. Now we don't have that therein. In place of that, we have what is called the effective tax rates. So every organization that's a member of a multinational group or all local companies that earn 150 billion net demand at about 150 billion and above are now required to have a minimum effective tax rate of 15%. That is, your tax over your profits must be 50%. And there's a cover tax, there's over profits, there's a definition of what the tax is, definition of what the profit is, but it must be 15%. That means if you have zero profits, you do not have to pay tax. It's only when you have profits that you pay tax. That's what this one talks about. A number of other levies. There was NASENI, National Association for Engineering, something that was the NASENI levy. There was a Police Trust Fund levy. There was Textile Education Tax levy. There was Industrial Training Fund levy. About NITSDA. There was National Information Technology Development Act levy. So there are 4 different levies that different companies were had to pay. Some had to pay 3, some had to pay 2, some had to pay 1. But all those 4 different levies have been combined into one called development levy. Again, we are trying to reduce the number of taxes that organizations have to pay. Chargeable gains are no longer taxed at 10%, but now they are taxed at your normal tax rates. So if you are a corporation having more than 100 billion naira in turnover, more than 250 billion naira in assets, that means you are taxed at 30%. Your chargeable gain will be taxed at 30%. If you are at a small company, 20%. If you are an individual, you pay tax on chargeable gains at your personal income tax rate. Very important, I'll talk about VAT. I'm moving to the right now. Killian did mention the fact that every organization can now claim improved VAT for every single improved VAT you pay. In the past, improved VAT claim as a set-off against output was limited to just goods that you buy to resell or raw material that you use to produce goods that you resell. It then meant that service providers, like all of us in this room, we were not able to claim VAT in the past. But now we can all claim VAT. I am very happy about that. And that's something very important. There's a very robust provision around VAT refund because, again, if you have input VAT that's more than your output VAT, then what happens? You can claim a refund, and the tax authorities have 130 days between when you make a valid refund for them to pay you the money. And if they don't pay you the money, then it's what that amount you claim automatically stands as a credit for you to use to offset any taxes that you are owing to tax authority. But you have within 12 months of when those VAT, when you pay that VAT to make a claim for refund. Okay? I just move to the next slide so we can talk about maritime sector. I'll leave this out. Yeah. So, what are some of those key changes that I will talk about? This is not the one I'll talk about. Okay. Yeah, this is where I want to go to. So let's look at maritime entities. What are some of those sector-specific changes that affect this our space? The first one is there's something that's called the priority sector. In the past, we used to have what's called the pioneer status incentive, where companies, certain kind of companies in certain kind of sectors or produce certain kind of goods were allowed to get tax exemption for 3 to 5 years. Now, the new set of laws has removed that incentive, but it has kind of replaced it with what is called the priority sector. So essentially, targeted companies within the priority sector are granted some tax incentives. And the maritime sector happens to be one of the sectors that can qualify for those tax incentives. So what does that mean generally for this sector? That means companies engage, for instance, in the construction of commercial vessels, ferry boats, and cargo ships are recognized as priority businesses. And they are eligible to claim for a tax credit. And the tax credit is equal to the capital expenditure you incur on that business, provided you get, but you need to apply and get the approval and all those stuff. But those incentives are available, you can apply for them. Now, talking about the digitalization as a competitive advantage, Killian spoke extensively about invoicing and all that. We think once your business is digitized, it means the transactions you are carrying out is visible to both you and tax authorities. And people typically will say that the internet does not forget. Those transactions have trails. So we believe very strongly that it will make reconciliation with the tax authorities when they come to review your books a lot easier. It will make a retrieval of those information and documents a lot easier for you when the tax authority asks for it. So we think e-invoicing and the whole digitalization drive of the NRS is going to improve. We can take advantage of those by keying into those and ensuring that we are properly set up for those systems. We'll talk about input VAT. So I've spoken about the fact that we can all claim input VAT. FRS has 1 month to refund and all that. What is the advantage of that for us? It means there's an improved cash flow. Because if I have input VAT, I can claim from FRS and they can pay me back my money within 1 month. My cash flow is enhanced. That's one. The two is that for those of us in this room, for instance, all the VAT we have been paying in the past, we could not recoup them from Apple VAT. Let's say, for instance, maybe our total revenue in a particular year is £1 billion. Our costs on which we are paid VAT is £500 million. In the past, you paid the VAT, the cost of £1 billion plus the VAT on that, and pay it to your vendors, right? You charge £1 billion to your customers. You charge 7.5% of £1 billion, about £75 million on that. At the end of 21 days after the end of the month, you have to pay the £75 million in full to tax authorities. But now, what you pay to tax authorities 21 days after the end of the month is £75 million plus VAT on the £500 million, which is 37.5 million. So you're only paying half of that to the authority because you can recoup all your input VAT. We believe that it releases a lot of cash flow for people in this room, particularly if your volumes are huge. Okay. What did you have to talk about? So what are some of the considerations for the maritime sector? One is to say that I've talked about the operational and cash flow impact. Talking about this technology and the systems upgrade. We need to just for us to be able to take advantage of those benefits that is that is offered by the automation and I would put automation generally within the tax space. We need to ensure that our systems are upgraded and ready to those advantages. For instance, how compliant are we? Where are we on our invoicing journey? Have you started transmitting your information to FRS on a real-time basis? And NRS has actually said that companies that don't want to transmit on a real-time basis, they are allowed to transmit on a near real-time basis. They haven't defined what that is. But at least they have made it very convenient and they're giving different options of how you can do it. What they are saying is, we just want to see your transactions. Let us make it visible to us. And that's all they're asking. So you think if you set up your system in such a way that you can take advantage of this, there will be tremendous benefits that people here in this room can take from that. And I think there's increased compliance requirements from NRS. That's definitely, for people in this room particularly, for the maritime sector, non-resident companies that are carrying on shipping business in Nigeria are now required to file their returns of their activities on their outbound cargo on a monthly basis. In the past, tax returns was required to be filed by every company in Nigeria once in a year. But now, non-resident shipping companies that are doing business in Nigeria, irrespective of all your outbound cargo, that is loadment into ships within Nigeria that's going out of Nigeria, that's where you are required to pay taxes, and on those transactions, those kind of shipment, you are required to file your returns on a monthly basis and remit your taxes. That's a low lot of applications on companies. In the past, you had one in a year, now you have 13. Because apart from the monthly returns you file, you still have to file your annual returns 6 months after your year end. Okay, that's one very important thing for us to note. Now, in addition to that, the requirement for monthly tax filings and payments places additional pressure on you. Now, for regulators within the maritime sector, it's a requirement that if any shipping company comes to you to them for approvals, they cannot give those approvals unless they get evidence that that company has complied with taxes. So it may be more difficult for people in the maritime sector to get approval from NIMASA and all those things going forward, because in addition to all those things they were asking for in the past, they will now be asking for evidence of monthly tax compliance before they give those approvals. Very important for us to pay attention to. And that could potentially disrupt your business. Because, I mean, imagine if you had to get this particular certificate or approval to get something done tomorrow, and I get there and they're saying, where's the evidence of tax? If you are not filed that tax return before, you need to take a few days to file your return. So you will add some disruption to your business. Very important for us to pay attention to this. So what are the tax strategies that we think players within the maritime sector can consider? One is you need to review and understand the entire tax reform. So when I say NTA, I'm talking about the entire 4 laws. Permit my use of just one. Nigerian Tax Act, Tax Administration Act, the Joint Revenue Board Act, and the NRS Establishment Act. You need to review them, understand them, and understand how it affects your business so that you can begin to put strategies in place to compliance. Tax compliance and optimization is, more than ever before, is very important. I cannot count how many of my clients in the last 3 months, when NRS sends them tax assessments after audits, that the penalty and interest is more than the principal liability. If you are owing $1 million in taxes that you could have paid, you could end up paying more than 2 million in total. I will say it again. Companies that say, I don't want to pay my taxes on time, I want to use the money for my business, when the IRS comes to me in the future, I'll pay the liability at that time. If your actual liability is 1 billion, assuming if NRS comes to review your records, and I agree with you, indeed, what you should have remitted that you didn't remit was 1 billion, we agree with you. You might end up paying more than 2 billion, depending on how long ago it was. So put it this way, penalty is 10% flat on the amount you are supposed to pay. But interest is at the CBN's MPR plus the spread. NRS typically applies a spread of 5. Today, MPR is 26%, right? If you apply 5% spread to that, that's 31%. Means for every 26% per annum. So for every year, additional year that you delay to make that remittance, additional 26%. In just 3 years, 20% times 3 plus 10% flat. In just 3 years, your penalty and interest is equal to your principal liability. So more than ever before, it is important to comply. So if you want to comply, you need to begin to assess your financial strategies to be sure that your business is restructured for optimization. So non-compliance can no longer be an option for you to optimize your taxes, because you know that what you pay more later will be more. So what you need to do to ensure that you are complying but you are being optimized at the same time, you need to proactively think about those things and do them at the right time. We think you need to engage professionals. Come to us, come to the law firms. They can advise you on what you need to do. Okay. For those of us in the professional services, I will just talk about a few that I haven't mentioned before. Input VAT claim I've spoken about. There's a reduced within tax rate for companies that provide professional services. Typically, engineering firms are those that are companies. For those of us that do accounting and law, are mostly partnerships, not limited liability companies. For limited liability companies that provide professional services, the rate used to be 10%, it's now 5%. So that's a within tax rate. That's a good one for those kind of organizations. Partnerships are now required to register, rather to submit and register their deed of partnership with the relevant tax authority, because that's what determines each of the partnership profit and how much of taxes each of those partners will pay based on their share of profit. If a partnership does not submit its deed, then the relevant tax authority is at liberty to decide how they want to share that profit among all the partners. For those partnerships that have all their partners in one state, within the jurisdiction of one tax authority, it doesn't make a difference, right? So, tax a junior partner more than a senior partner. We can come in house and resolve it among ourselves and all those. But imagine that you have a partner in Lagos and another partner in Oyo State, and the partner in Lagos has already paid tax on 50% of the revenue, but because you didn't submit your deed, and Oyo State government insists, as far as they are concerned, 70% should be paid in Oyo State. How do you reconcile that? So it's very important. That's a new provision of the law. Every partnership is required to submit their partnership deeds. Another provision I wanted to highlight on this one, the last one to the bottom right, where we say taxation of profit. Any person, whether a resident in Nigeria or not, that shares out of the profit of a partnership, whether by direct sharing of profits or otherwise, is required to file tax returns in his name and pay tax on that profit that he shared. I think that might be applicable for those of us that run professional service firms that have some form of international affiliations or the other. Whatever money we are paying to our parent company or whoever is giving us license, if it can be seen to look like profit, I can imagine, because if I was the tax authority, that's what I would do. I will come and tell you, as long as concerned, this is profit sharing. That person that you are paying the money to needs to come and register for tax in Nigeria and pay tax on that profit that he has shared. So those are the two provisions I thought I wanted to mention that are key for us. The last one I wanted to add, this is important, is for those of us that run professional service firms, like engineering and all that, that are companies, you cannot claim that because your turnover is less than 100 million, your asset less than 250 million, you are a small company. Therefore, you want to be paying tax at 20%. No. Professional services organizations are excluded from the definition of small companies. We are all big companies because we are big people. Okay. So, thanks for the opportunities and all those. I think they're quite similar to what we have seen for the maritime sector. So I will skip those. I'll just go to my concluding thoughts. And In the words of Peter Drucker is one of the world-renowned speakers on issues around management. He says the best way to predict your future is to create it. The best way to predict your future is to create it. So in creating that future that we expect and anticipate for ourselves, that we want for our businesses, what are those 4 things I think we should be doing? One is take action. Because we say what you are today is a consequence of the actions and the choices you made yesterday. So what you are going to be, what's your business going to be in 2 years' time will be a consequence of the choices you make today. So determine what you want to be, take the appropriate action today. 2, be proactive. Don't wait for things to come and happen to you. Actively design your organization. Ensure that your task strategy aligns with the overall corporate identity. So, whoever is handling your tax affairs or items, issues that are the tax touch point at the point in time, they are not confused as to what they are expected to do, because tax strategy is clearly mapped out, clearly documented, clearly communicated to all affected team members. 3, focus on the key areas. So you need to determine what matters to you. Now, if 10 things matters to you, you may not be able to have influence and control over 10. If it's only 3 you have control over and influence over, you need to ignore those you cannot influence. Because no matter how much time you spend on those ones, it won't change the outcome. Those that you can influence, identify them and spend time on them. Because your future is shaped by the thoughts and actions that you cultivate today. And the last thing, embrace change. Change is the most constant part of life. So proactively look out for those changes that are coming in your organization. And the best way to determine how those changes impact you is to proactively be the one that shapes how they come to your business. So thank you so much for listening to me, and it's been a pleasure talking to you today.
All right. Thank you so much for a good job, Mr. Olukunle Ogunbamowo. Thank you so much, sir. All right. We'd like to go to one of the sessions I consider very important as we engage today, which is the panel session. I told you much earlier that we had this same session moderated last week by our sister Foluke Akinmoladun. Please put your hands together for her as she comes up to moderate this session again today. She will bring up our panel discussant, then moderate that for 25 plus 15 minutes, 40 minutes. Then has another 10 minutes for question and answer from the audience and engagement. Then we will be good to go. Please put your hands together once again for Foluke.
Sorry, sir. Okay, great. Good afternoon, distinguished ladies and gentlemen. My name is Foluke Akinmoladun. I'm the secretary of the LCCI Maritime sector. I'm also a maritime lawyer, an accountant, mediator, and arbitrator. And I have, thank you, I have the singular honor this afternoon to call on a very stellar panel to further interrogate a lot of the new areas in our tax system that will be, whether we like it or not, we'll have to comply with going forward. So I have the pleasure this afternoon to call upon Mr. Chukwuka Ikwazom, SAN, who is ably represented by Mr. Agada S. Agada, Managing Associate, Aluko Anoyebode. While he's coming up, I'll quickly read Mr. Ikwazom's profile. Now, Mr. Chukwuka Ikwazom is a partner of the Dispute Resolution and Tax Practice of Aluko Anoyebode and heads the firm's taxation practice. He was elevated to the prestigious rank of Senior Advocate of Nigeria in December of 2023. He's a fellow of the Chartered Institute of Taxation of Nigeria and was the was a member of the Institute's indirect tax faculty for several years. He was shortlisted as Tax Litigation Lawyer of the Year in 2025 ITR Awards for Europe, Middle East, and Africa, and he's a thought leader and facilitates training on taxes and other subjects. He was the chairman of the Nigerian Bar Association, Lagos branch from 2017 to 2019. Ladies and gentlemen, please a round of applause for Mr. Ikwazom, ably represented this afternoon by Mr. Agada S. Agada. Sorry? Agbada, sorry. My sincere apologies. Agbada, Managing Associate, Alukano Yubodi. Our next speaker this afternoon, just a minute, is Dr. Emeka Akabogu, Senior Advocate of Nigeria of Akabogu Law. And while he's making his way upstage, I will be reading out his profile. Okay. My apologies, just a minute. This doesn't usually happen, but the OTL Downstream Development in Africa, a Pan-African initiative for the promotion of downstream petroleum business and policy. He's a recipient of many industry awards, and he's a fellow of the Chartered Institute of Shipping. Ladies and gentlemen, a round of applause for Mr. Akabogu. Our next speaker is none other than Celestina Wabweze. Please, as she comes up, let me quickly read her profile. She is the managing counsel at Olanimu Ajayi LP and a distinguished lawyer with over a decade of experience spanning taxation, policy reform, and data protection. She's renowned for her expertise in domestic and international tax, data protection advisory, and legislative drafting in several landmark Nigerian statutes and regulations. She advises in leading corporate and government institutions and multilateral organizations. She's a fellow of the Chartered Institute of Taxation and a certified information privacy professional in Europe. She holds an LLM in international taxation from the New York University School of Law. Thank you, Celestina, for joining us this afternoon. So we're going to be talking about tax and tax compliance. And one of the things that have come out of the discussions, or rather the presentations made earlier today, is the fact that it is no longer business as usual. There's definitely a need to begin to address things from a different perspective. And so this afternoon, between 2 to 5 minutes for each of the questions, please, for all the panelists, I'll be asking questions that will help us to hopefully better understand the new terrain that we're getting into as far as tax is concerned in Nigeria. And my first question would be to Mr. Agada. Agbada. Okay, I'm sorry. Agbada, Mr. Agbada. Okay. From a tax and oil and gas perspective, especially since oil and gas is also going to be a major revenue earner for the government, what compliance risks does e-invoicing exposure introduce for regulated industries?
Okay. Thank you for that question, but before I attempt an answer, please, may I introduce myself for the benefit of everyone. My name is Agbada. When you think about 1,500, I don't know if it is still 1,500. It is the same spelling, right? And it is Agbada S. Agbada, right? So Agbada raised to power 2. All right. So from the conversations we've had so far this morning, I think that Killian's presentation kind of puts me a bit at rest. about the compliance risks that and exposures that the e-invoicing regime would create for companies, right? But the only thing I would note is that we are still operating in an environment where infrastructure challenges, power sector challenges, and several other challenges are still very rife. The way the law is drafted is such that once that system has been deployed, a company, a taxpayer, will be required mandatorily to process all invoices through that system. There is no allowance for things that may affect how the system operates, that may be entirely beyond the control of a taxpayer. And the penalties are also significant, right? Non-compliance with the e-invoicing regime. If a taxpayer fails to process invoices through that regime, there are administrative penalties that operate on a daily basis, 200,000 per day, right? So what then happens if you are dealing with a situation where there is a downtime, particularly for the kind of transactions that Killian made reference to, B2B and B2G transactions that require approval from the NRS for you to be able to. So those infrastructure challenges and maybe technological issues, and of course, technological systems are not human beings. So you always have issues with those. So, but I think that if the NRS has provided a system to be able to address some of these problems that are foreseeable and some unforeseeable, the e-invoicing regime would be a game changer, not only for the tax authorities, but also for taxpayers. And at this point, I also need to mention that the initial fears around e-invoicing was the real-time visibility that the taxman would have over transactions of taxpayers. But the thing is, even without the e-invoicing system, the tax authorities have very wide, robust powers to access documents and request for documents, and the obligation is there for taxpayers to comply with those. So even without the invoicing regime, if a taxman wants to see what a taxpayer is doing, the law allowed the taxman to do that. So yes, I mean, if the NRS will be able to provide systems that will address these challenges that may arise, I think that, I find it difficult to really foresee significant challenges that, or exposures that it would create for oil and gas companies and other taxpayers.
Thank you very much. Let me pronounce his name again, Mr. Agbada. Agbada, okay. Mr. Agbada. Okay, right. Thank you very much for that. In other words, some of the compliance risk we're looking at is already going to be created by reason of infrastructure challenges. So those need to be addressed if we're trying to come into the e-invoicing system. And that dovetails into my next question for Dr. Emeka Akabogu, Senior Advocate of Nigeria. So how will Nigeria's tax reforms practically impact maritime trade operations and particularly shipping documentation?
Okay, thank you very much. Just like every other segment of the economy, there are implications across board. From a very specific standpoint, I think first there's a reference to both the freight and non-freight elements of taxation, both from resident and non-resident actors. So while more specifically the Act has implications for non-resident actors, it still does have implications for resident actors, which, for instance, from the presentations which we heard earlier from the guest speakers, you could see an increasing focus on integrating the systems to ensure that taxes are fully appropriated. One of the more important taxes you find within the shipping sector relating to freight is actually not mentioned in the Nigerian Tax Act, but by virtue of the Nigerian Revenue Service now having full coverage of all revenues, it's implicated, and that's with regard to the 3% levy chargeable on freight, incoming freight. So the Act makes reference to outgoing carriage, but incoming carriage, there's already an existing 3% freight previously or collected by NIMASA, which obviously will now be under the broad supervision of the Nigerian Revenue Service. Now, but beyond that, more specifically mentioned are the references to freight and non-freight taxation. That's actually explicit in the presentations by both speakers earlier. The freight revenue will be related to, it has always existed actually. In fact, it existed but was not actively, until 5 years ago, was not actively pursued as a head of tax. And then when they decided to pursue it as a head of tax, it came under a very broad and not very well framed procedure. But what they've tried to do, and I believe they'll be doing going forward, is to structure it in a manner that ensures clarity and ensures consistency. And that's a reference to the monthly reporting which is required. So that's as that goes. So from a non-freight point of view, it's equally relevant because so it's not just for freights, outbound freights, but there's a reference to non-freight tax as it affects vessels. So you see a reference to non-freight tax which relates to vessels involved in exploration and production of natural resources. So the question in that regard will be, what will these be referring to? Obviously, there's a reference to vessels involved in vessels like FPSOs involved actively in undertaking exploration and production. So they're not earning freight per se, but they are involved in services which are income generating. So that applies to them. Of course, obviously, I think an extension of the Nigerian Tax Act beyond what we had previously will relate to the enforcement regime. So you now have an enforcement regime that involves the regulators that are directly involved in interfacing with these vessels and shipping companies. So by the time you ordinarily have a Nigerian Ports Authority, a NIMASA, Nigerian Customs Service, or any other regulator that's routinely involved in that interface, now adding a layer of requirements relating to compliance with taxes, then of course that impacts your business. Obviously, this will have implications, which probably in the course of the presentation I'll still expand upon.
Thank you very much, sir. I want to just allow you a second bite at the cherry to clarify. How will it affect cross-border transactions? Because maritime is naturally an international trade. So how do we avoid a situation where a Nigerian is having to pay tax abroad with respect to freight that they're importing and will not end up having to pay tax on that same cargo when it comes into the country?
Well, so that's where very detailed reporting, very detailed record keeping would be of advantage. Because to that extent, you see, and it's a challenge which we have within as far as maritime operations go. The nature of operations involved multiple parties, multiple jurisdictions. You're dealing with the cargo, you're dealing with the ship, you're dealing with crew, you're dealing with a shipper that is not necessarily residents. So you're dealing with multiple parties that are across jurisdictions. And some provisions, which I believe eventually may come to litigation, will relate to the relationships between all these parties, their transactions, and the references to Nigerian tax jurisdiction. So an important component really would be record keeping to enable the appropriate or effective allocation of responsibility, incidents of the taxation within the context of the various parties and jurisdictions.
Thank you very much. Okay, I'll give you just 1 minute because I need to ask Celestina her own questions.
Okay, thank you. So I think that another thing that would help in that situation to relieve incidents of double taxation would be the relief provisions in the Nigeria Tax Act. So Nigeria has double taxation agreements with countries which provide relief from double taxation. But in addition to those bilateral agreements, Nigeria also provides what we call unilateral relief from double taxation. So if a Nigerian resident shipping company has paid tax on income that is also subject to tax in Nigeria in any other jurisdiction, then the company can claim a relief. And the way the relief works is that it's a credit system, right? So you can claim a credit of the income tax that was paid outside Nigeria, and that credit would directly affect the amount of tax that you'll be paying in Nigeria, because of course it reduces the taxable income. And there is a formula that the law has provided, but for our purposes here, I just wanted to mention that a taxpayer that finds itself in that situation should try to make use of the relief provisions in the tax laws.
Okay, so my next question is now to Celestina. Celestina, you're an international tax expert. So now that we have the e-invoicing system, how do you see it intersect with international tax compliance obligations for cross-border businesses? Mr. Agbada has mentioned for Nigeria, but when it comes to international tax obligations, how do you see e-invoicing having a play in this?
Okay, thank you for the question. I think as a foundational point, since we are dealing with international tax here, I would like to provide additional context. So if you look at e-invoicing, not even e-invoicing, invoicing generally is one of the fundamental and oldest instruments when it comes to commerce. And clearly, even before globalization, and what we've seen is that it's been predominantly in a human form, human documents. So you will see human beings create it, archive it, process it, as the case may be. And even when certain countries decided to even take the bold step to address some concerns around some of the nuances with respect to the traditional invoice, it became a global discussion. So as at 2003, you had Chile introduce their first e-invoicing platform, and that was then followed by Brazil in 2006, and then some other countries then followed suit. So subsequently, there was a conversation around the OECD countries during Tax Administration Forum, where the OECD specifically signaled that e-invoicing, or indeed taxation, must be done in a manner that is integrated into the natural system of taxpayers. So the systems that they're already used to in terms of generating their activities, in terms of doing their operations, what they are used to, that you have to integrate taxation into those systems. And the implication of this when it comes to e-invoicing is that by the time these sales happen on your system, automatically the tax authority becomes aware of it. And when you then unpack this and tie this with respect to the global and tremendous efforts that we've seen and what Nigeria is now used to, or what Nigeria has finally aligned with, you will then see that there is an intersect between these practices and the legal framework in different countries, and in terms of business operations generally. The first is what I would call the legal consequences of not complying, and this is beyond the penalties, because we've had discussions around the penalties. My primary concern is what I would ordinarily describe as a shift from assets to liabilities. So in other words, with the MBS model that we now have, the implication is that e-invoicing has a normative or legal character. So it's not your traditional electronic documents that evidences transactions. So it's gone beyond that. The implication is that with that instrument, it would technically decide how a particular transaction is going to be treated, whether it's going to be on the asset side of things or it's going to be on the liability side of things. And I will just give you one example. So imagine if a supplier that hasn't complied with the e-invoicing system decides to issue an invoice to a buyer, and the buyer eventually proceeded to make payments. And let's say that transaction is one in respect of which impute VAT can be claimed. So there is still that risk that to the extent that that invoice was not recognized on the platform of the NRS, that asset, which is your input, may eventually turn to liability because it may eventually not be able to claim it. Now, see dealing with VAT implications. So another thing is that when you see the new regime, you recognize that a lot of goods has been reclassified. So we taxpayers, for instance, those working in the professional services, we cannot claim input VAT when it comes to exported services. Now, your e-invoice, when it comes to an audit, in an audit situation, is the prima facie documents that would ordinarily show, without more, it would ordinarily show the place of the supply. So let's say, for instance, I'm issuing an e-invoice to a counterparty in Dubai, and maybe I had to address it to their head of, maybe to their branch or their business in Nigeria. Clearly, the NRS will not accept that as a non-resident supply. They won't accept that as a non-resident supply. And the implication is that that particular transaction will be disallowed for purpose of claiming input VAT on it. Another implication is when it comes to transfer pricing amongst related parties. Now, if you have related parties that are residents in countries that operate the e-invoicing system, the implication is that when there is an intergroup invoice that is generated, automatically the tax authority in the issuing country and the tax authority in the receiving country has visibility about that invoice. So if for any reason the underlying transaction was underpriced significantly in a manner that even before your transfer pricing documentation is filed with authorities could ordinarily raise some concerns, the tax authority immediately will launch into action. And they would not necessarily have to wait till when you're filing your transfer pricing documentation and disclosure. They may, on the basis of that, ask for an audit. And we all know that under the transfer pricing regulation, that once the NRS mandates that you produce documents with respect to your benchmarking analysis for related party transaction, you have about 21 days to do that. So the implication is that as it relates to that transaction, automatically tax authority are able to make an assessment even before the normal filings are done. Another implication is when it comes to permanent establishments. Now, the new regime, as we all know, has detailed provision on permanent establishments. But before we even go to that provision, one fundamental tool or document that prima facie would show whether there is a risk that a particular non-resident entity has a permanent establishment in Nigeria is your e-invoice. So when a non-resident consistently begins to issue invoices to Nigerian residents, so that invoice has track record in terms of the nature of the transaction, the frequency, the amounts, the volume, and the like. Automatically, the tax authority picks up the invoice and begins to deed it for permanent establishment purposes. So it's a document that prima facie would even raise that concern. Another issue is when it comes to team capitalization. So we know today that under the new regime, it's no longer team capitalization in relation to foreign loans, related party loans. So this has been expanded to related party loans that are domestic and foreign. So it's not just foreign loans. So the implication is that at the point when the NRS is determining whether indeed your interest expense should be disallowed or it complies with the team capitalization requirements, your e-invoice, in terms of how you've described that payment, is another document that they will also take into account. I mean, for the sake of time, I would like to stop here, but the point is it's no longer business as usual, and e-invoice is one thing that has clearly gotten international momentum when it comes to international tax, and indeed tax administration in different countries have indeed keyed into it.
Thank you very much, Celestina. I think that you have helped us to understand the concept of really it is not business as usual. And I think what was particularly, I would say a bit disturbing is the issue of non-compliance risks are actually now going beyond penalty, but moving to an issue where your assets could end up becoming liabilities, which brings up an insolvency question, because we could possibly see companies who would otherwise have had cash flows, positive cash flows, begin to experience negative cash flows, and thereby having insolvency challenges, whether it is temporary or it becomes permanent. So that brings me to my next question, Mr. Agbada. How should distressed and restructuring companies manage insolvency exposure under this new tax compliance regime?
Okay, it's an interesting question, but the starting point of my response is that the Nigeria Tax Act and the Nigeria Tax Administration Act don't have provisions that will specifically apply to companies that are distressed, right? However, there are provisions in the Tax Act that would indirectly be of importance to this sort of companies. So there are clear obligations regarding when a company is winding up, right? When the company ceases to conduct business. In that case, there are obligations on the liquidator to ensure that tax liabilities are settled as a priority obligation before distribution of any assets to shareholders, right? And the law now even imposes a personal liability on liquidators or administrators who fail to comply with this obligation.
Personal?
Yes, personal liabilities. Now, in addition, the concept of a company in distress also suggests that the company is not profitable, right? And if the company is not profitable, then the tax exposure of that company should also reduce, because our tax system operates on profits, right? Companies pay their taxes on profit and not necessarily on turnover, except in limited situations where the Nigeria Revenue Service receives the tax returns of a company and then takes the view that, you know, instead of taxing the company based on the returns, they would tax the company on what we call a deemed profit basis of assessment, except in those limited circumstances where the turnover of the company can then be the basis of assessment. Taxes generally are paid on profits and gains. So if a Nigerian company is distressed, is struggling, and it is not making profit or is even making losses, what it means is that, you know, the company would not be paying income tax. But that would not exempt the company from complying with other tax obligations, including filing obligations to ensure that filings are done within the time frames prescribed by law. It will also not exempt them from complying with the e-invoicing obligations, such that, you know, you still be required to process your invoices through the appropriate channel. But even in addition, right, the law has now provided that losses can be carried forward indefinitely. So a company that wasn't profitable or had suffered losses in previous years, when the company then turns around and starts making profits, the company can, you know, deduct all the losses that had been suffered in previous years. That would provide a lot of relief and assist companies to get on their feet, right, before they start paying taxes again. Final point. Final point. Now, companies that are undergoing restructuring, the law has provided made specific provisions to deal with those situations. So depending on the nature of restructuring that is being undertaken, then there will be some relief. So for instance, if it is a merger, if a company is going into a merger with another company, then the assets that are transferred, you know, in that merger arrangement would not be subject to capital gains tax, because they would not be considered as chargeable transfers. Restructuring arrangements that are done in accordance with the Nigeria Tax Act would also be exempt from VAT, such that the transactions, the transfers that are made within the context of that transaction will not be treated as the supply of taxable services or taxable goods. So for that reason, so the law contains provisions that would, in one way or the other, impact, and I believe positively, right, companies that are undergoing restructuring or, that are in distress.
Thank you, Mr. Agbada. So what that essentially is telling us is, well, while the law doesn't have clear provisions with respect to restructuring, it already does indirectly cover the fact that you only tax profits.
No, sorry. The law contains clear provisions on restructuring.
Okay.
Companies
now I'm talking about
distress,
the tax law.
Yes, the tax law.
Okay.
Companies in distress are not under any special regime.
Okay.
So it is not like the law has said, if you are a company in distress, you'll be exempt from these obligations and the likes.
Okay.
What the law has provided contains certain provisions that can, be leveraged by companies in distress to get some relief.
So in other words, they need to get proper advice as to how they report such that they can take advantage of those provisions.
Of course.
Noted. So my next question will be to Dr. Akabogu, Senior Advocate of Nigeria. Sir, what maritime-specific legal challenges do you foresee with the rollout of the e-invoicing system?
Okay, thank you. That e-invoicing is, I think it's going to be particularly challenging. In fact, I was listening to Celestina speak, and I was convinced that she was counsel to NRS on that point. She's speaking she's pushing it with such passion. Listening to Killian's presentation, Killian gave us an outline of countries that have implemented e-invoicing. And I noted, and I asked him that question, these are all African countries. Is this a problem that is exclusive to Africa? Of course, I understand the basis of this. The basis really is that, government wants visibility and certainty of data and figures relating to the transactions for which tax is paid. But I'm concerned. I'm actually a bit concerned about how well this could stand up if there is a challenge to its constitutionality. I've not thought about it in detail, but it's just playing on my mind. Because as I think Killian was the one that said it, that what is happening is that government is coming right into your office, in between your trade partners. I know there is a duty, there's a civic duty to pay taxes. That's a duty for which you make your reports and submit your taxes based on whatever it is, after which government may reconcile. But coming before you pay the taxes right into your office and in between, it is something which, if one analyzes and researches more deeply, could be a basis for contention on the constitutionality based on one or two provisions. But that's just an aside. In terms of the other challenges, I see a challenge relating to seamlessness of integration. And I say this because we are in Nigeria and we see the difficulty that is associated with things like this. Let's have a very practical and ongoing example. The single window systems. Anybody who is honest, who is within the maritime industry, would agree that so far it has been a fiasco. It has essentially slowed down as opposed to quickened the process of clearance. And it slowed it down in a significant way because the very relevant parties who should be on the platform have not seamlessly integrated their processes within the system. And those charged with that responsibility have not been that effective. And of course, there's always been that issue of interface. There's interagency territoriality that slows down the efficiency of the purposes of this thing. And if you don't take account, in fact, I'd thought that the National Single Window Office, being directly linked to the president, will take care of that. But apparently it's not. Maybe, I don't know if they are directly getting the access which they need. But I understand, for instance, SON, NDLE or NAFDAC are having challenges with integrating. Now, and these are still the same organizations and institutions that have historically found it very troubling to flow with a seamless process. So my point is, if the National Single Window System, which is a flagship initiative of the president's, has suffered such a catastrophic failure at this onset, then what more? A more elaborate and potentially more data encompassing platform like this. So for me, that will be a challenge, an operational and ultimately a legal challenge that will be impacted.
Thank you, sir. What I hear you say essentially is that if on a smaller scale, we're not getting it right, what will happen when it's on a larger scale? But that will then, sort of beg the question, and I want to ask Celestina this, that we already, like Dr. Akabogu has mentioned, we're looking at a situation where there will be a challenge. There will certainly be a challenge on integration. But let's look at an even broader aspect, which is data protection, which again brings in the issue of how much of government do you really want to have in your businesses. And so what data protection and privacy risks should firms be aware of under this digital tax reporting system?
Okay, thank you for that question. I'm actually not holding the brief of the NRS, but
you wish.
I think it's important to set this context. Now, before the privacy risk, again, it's important to set the foundations. And I think the keynote speaker indeed tried to unpack how the system was going to work or is currently working. But from a privacy standpoint, there are fundamentals that we need to take into account. The first thing is that there is this misconception that once you're doing integration, because we clearly know that you can do outsourcing or integration. So there's that misconception that once you're doing integration, the NIRS automatically has a plugin into your entire ERP system, and they can access everything. That is not necessarily the case, and I will tell you why. So based on even the keynote speaker's address in terms of the explanation that we got earlier today, what that clearly means, or what that evidences, is the fact that when you're doing your integration, your ERP system definitely has different models. So you have your HR model, you have your payroll model, you will have your finance model, you would then have your e-invoicing model. So for the purpose of generating your e-invoice, there are minimum information, data field that must be contained in that invoice, and that is the information that the NRS is interested in. They are not interested in any other information other than that, at least as of today. That doesn't necessarily mean that they cannot request for additional information. But for the purposes of the integration, that is the information that they are interested in. And it works as a transmission protocol. So in other words, the invoice is generated right from your accounting system. It doesn't leave your accounting system. You generate from your accounting system, and then you transmit through NRS system for validation, pre-clearance, and for the cryptographic stamp that will be affixed to it. Now, the other thing that we also need to clarify is that it's not a continuous access. So when I say it's not a continuous access, it's the fact that it is only triggered at the point when certain activities are done on that platform. So in other words, at the point when you're generating the invoice. So it's not the case that NRS is somewhere monitoring your system and looking at everything. So it's at the point when you generate that invoice that transmission and data protection processing protocol then happens, right? So that's another point to take into account. And finally, is even the fact that even as it relates to your own system, there are minimum criteria that have been prescribed in the manuals that we've seen circulating that you must adhere to. First is that your system must be capable of generating the invoice in a structured format. Secondly, the system in question must have real-time or near real-time transmission protocol. Remember that the invoice has to leave your system, go to the MBS, and then be certified or validated by the tax authority. So that transmission protocol is very important. Another functionality is authentication and security protocol. So at the point of transmission, whether in transit or in rest, that data must be encrypted. So those are minimum safeguards that the NRS has prescribed in their regulation or in their manuals with respect to assessing whether a particular accounting system is even fit in the first place to be integrated into the NRS system. I think that is somewhat comforting, but it doesn't take away the risk. Now, from a privacy risk perspective, as we all know, no particular system is actually exonerated or immune from vulnerability. I'm sure we are actually aware of the recent incidents, cybersecurity incidents with the CAC platform, and even the recent alleged news about the Bank Association of Nigeria platform. That clearly means that no system is immune. Now, the implication of this when it comes to integration are in different folds. One is what I would call the expanded data risk. So if you look at the traditional invoicing model, what it envisages is that even though NRS has plenitude of power to demand for information, from a practical standpoint, it is not on a continuous or real-time basis, meaning that information can only be availed NRS if they make requests during audits or if for whatever reason additional information is required even post-audits. So they don't have real-time access to your transaction. However, on the flip side, when you then look at that in the context of what is happening today or what has been designed under the MPS system today, the implication is that NRS would have real-time access to transaction. If you look at this from an individual transaction, it doesn't necessarily pose any significant risk. However, if these transactions are aggregated in thousands of it, so if you aggregate thousands of transactions about a particular entity, what is clearly evident is that it will build significant profile about that entity. So you will have information dealing with the nature of the services that the entity provides, who they compete with, or who their customers are, their pricing models, their margin, and the like. Meaning that if for whatever reason there is a cybersecurity incident and eventually a breach, it is not just a matter that is limited to tax compliance. It is a real competition, privacy, core business risk that definitely that breach will throw up. So it's beyond tax, and that is why this is very important. Another thing that I would also like to mention in terms of the risk that we see is with respect to the integration protocol, particularly for businesses that don't have this system and have to rely on third-party system to do this. Recall that I mentioned earlier that when it comes to the traditional invoicing system, there is a limit to it's not like there is a limit, but it is not on a continuous basis, right? The implication of that is that the window of access by which a particular data set under the traditional model can be intercepted, corrupted, or compromised is very small compared to what the MPS system currently gives us, right? Because if you look at the MPS system, and to the extent that it has clear large volume of transaction being reported to it, the implication is that for every single activity that involves the generation of invoice, different activities has to occur concurrently. So if you see an organization generating, let's say 50 invoices, there will be separate or at least 50 interconnection that has to happen. So there will be separate transmission or interconnection that has to happen between that activity to when the invoice will eventually reach the NRS. So that particular internal process of that organization has to be transmitted to third party or intermediary platform. It then has to go to the NRS platform. And for each point of contact, there is a risk. Meaning that if for any reason there is a breach or there is a heightened risk during any point of transmission, then that aspect of data that has been availed to that particular system becomes vulnerable. Finally, is even as it relates to the concentration risk, what I would call the concentration risk. So we all know that to the extent that this system is aggregating data from different aspects of the sector, from taxpayers, particularly the large taxpayers, the implication is that it becomes very attractive it actually becomes very attractive for hackers. So as against going through individual systems, they would rather say, let me go to the database where I can aggregate this data. Why do I have to start visiting individual system? Meaning that there are heightened protocols that must be taken into cognizance when in deploying the system and when integrating into the NRS system.
Yes, thank you very much, Celestina, for that. And I really need to, just because for the sake of time, but I want you to kindly tell us, what should NRS be looking at in terms of protecting data? And I'm saying this because Nigeria doesn't necessarily, I mean, I don't know about now, but I thought last year, we don't necessarily have the inbound infrastructure to actually store this data. Some of this data, by reason of the very system of the world's digital infrastructure, will be stored in places outside Nigeria unless you know of a different system that NRS is running. And so the question is, what is the risk that we're actually exposing indigenous transactions to foreigners who are who will be custodians of this information?
Okay, so I don't know where the particular system or the cloud is stored, but the point is that to the extent that there is an interplay between Nigeria and any other country where this system information is stored or where it's archived, automatically it triggers the cross-border transaction, cross-border compliance requirements under the data protection law. So as a foundation, NRS is not immune from data compliance protection laws. They are not immune from it. So you can sue NRS in the event of a breach if for whatever reason their system gets compromised. You can validly sue. The implication of this is that it is actually expected that in the course of deploying this system, they would have gone through the data protection requirements for deploying a system of this nature. The first thing is that a DPIA ordinarily should have been carried out, and certain technical and organizational measures should have been also be taken into account in deploying the system. And I think to a large extent, without holding their brief, in terms of some of the things that they've indeed circulated so far, it would appear that the way the system is designed, it is designed inherently to take into account privacy. So the system allows you to put forward just minimal information when it comes to invoicing. So typically what would be contained in the invoice that you generate. So it's now left for the taxpayer to decide additional information that they want to put forward beyond what the NRS has requested, which then comes with another risk.
Okay, so let me come in, sorry to come in, because I think this is a very important point for all of us in the room. And I know you say you're not holding brief for them, but the point for all of us is our data safe? Because if you say minimal information, I'm still going to have to put the people that I'm transacting with. And that still brings up the competition risk that you mentioned. So how do you think the government can buy the trust of the polity in ensuring that there is compliance when you know that your information is safe?
Okay, so I would assume that before the deployment, they actually worked closely with the NDPC, because I'm aware that the NDPC also have collaboration arrangement with different public institutions. So the implication is that before the system was deployed, they would have ordinarily look at the prototype, go to the NDPC to explain the functionality, and where there are gaps, maybe the NDPC would have identified those. I'm also aware that it is actually ISO compliant. So I think that also gives a bit of comfort. But as I said, there is no system that is completely vulnerable, right? The expectation is that beyond the technical measures that we can see that perhaps they've indeed integrated, organizational measures are actually very fundamental. So in terms of where the information are archived or where they are stored, the cloud where this information are stored, it is expected that they would have cross-border arrangements in terms of data protection documents that they would have entered into with the data processors in those countries. It is also expected that there will be continuous training in terms of the NRS officers that are indeed mounting and administering this system. I know that under the Act, there is a penal provision. There's a penal provision that says that whatever information that is disclosed by the officers of NRS on that platform carries a fine. So their officers are not even required to disclose whatever information that we have on that platform. However, I mean, the way we see things is that you can have those things in the law, but at the end of the day, it's the implementation that matters. So beyond the technical measures that we can see, that organizational measures is very important. Access control is very key. They shouldn't give access to persons that ordinarily don't have any business having access to that system, because the more people that accesses the system, the heightened risk, right? For each access comes with a risk and comes with heightened protection in order to ensure that there are no breaches. So the point is, beyond the technical measures, organizational measures are indeed very, very important.
Thank you very much. And I'll going through my last round of questions, and please, let's kindly just keep the answers to 1 to 2 minutes. So, Mr. Agbada, what practical steps can firms and companies take to avoid tax disputes arising from documentation and reporting failures?
Okay, so the first thing to note is that under our laws, a taxpayer that is disputing a tax assessment, if the dispute is based on the fact that the tax is excessive, that taxpayer bears the burden of proving that the tax is excessive. So if you receive a tax assessment of 10 billion naira, and of course we've seen assessments that are much more higher than that. We've dealt with assessments that are even more than $1 billion, right? So if you receive such an assessment, at the end of the day, the law places a burden on you to establish, if you dispute the assessment, that the assessment is excessive. And you can only do that by documentary evidence, not by oral evidence. And our courts have emphasized this point in several cases, several tax disputes, that you can't just provide an explanation. Even your internal processes may not be sufficient proof of the fact that your tax liability was meant to be lower, right? You need documentation to do that. So beyond the fact that failure to file documents, failure to report transactions in terms of within the confines of the law or as prescribed by the law, carry separate penalties. At the end of the day, even in an audit situation, you need documents to be able to support your position when the taxman eventually comes calling and you're having an audit. And if you do not have a proper document management system, you find yourself holding the short end of the stick and at the mercy of the tax authority. So documentation, reporting obligations, those are very fundamental obligations within the tax system, tax administration, because a taxman that has issued you an assessment, it could even be a best of judgment assessment. It is not because the taxman has seen that you engaged in any form of transaction, but the taxman could just wake up and feel that, okay, this man was on the news the other day, and I can see that from the wristwatch he was putting on, it will cost $1 million. He's the CEO of this company, right? So we should be able to collect this. And they can slam you an assessment. If you do not have proper documentation to support your dispute or objection to the assessment, you might end up paying a tax that you should never be paying. So just emphasizing the need for taxpayers to ensure that there is proper documentation, and especially in this new regime where we are expected to see a more aggressive level of enforcement of tax obligations.
Thank you very much. I'll quickly move on to Dr. Akabogu. How should maritime operators adjust contracts and compliance processes to stay aligned with reform expectations?
Okay, I think that one is straightforward. What is important really is the word you've used, compliance. So there's a letter of law, and there's a path to compliance, and then comply. So this event is organized by the Maritime and Professional Practice Group. The Professional Practice Group is grounded in professional support for compliance. So even amongst ourselves, we need to comply. So you have the need to ensure that either in-house or working with counsel, accountants, other professional services, the letter of the law is maintained. Of course, from a contracting point of view, it's important that the companies that are involved in transactions have visibility of the implications when they're dealing with all the other parties that they're dealing with against the context of, again, the compliance which is required. So contractual provisions which reduce the likelihood of liability are important. Indemnities are very important. References to the tax provisions themselves within the contract are important to ensure that the visibility of that remains, and that if there are incidents or of non-compliance, then it doesn't fall on the party that is involved. So
All right, thank you very much, sir. And finally, to Celestina, how can organizations balance regulatory tax compliance with global data privacy standards? And I want you to put this in the context of now that there will be minimum disclosure on the part of the companies to NRS. How does that affect global data privacy standards with respect to non-disclosure agreements that you have with your foreign counterparts?
Okay, so in terms of balancing regulatory compliance when it comes to taxes, and then balancing that against global privacy issue, I think the starting point is the system itself. So as I mentioned earlier, the system must be built in a manner that inherently recognizes privacy. And that then ties back to the minimum information that is required. And from the organizational standpoint for businesses, why this is important is because of the principle of data minimization. So the implication is that you don't necessarily need to provide information more than information that has been requested. So in the past, I've seen invoices drafted in such a manner that literally contracts will be transposed into invoice, and you'll be seeing provisions that are not necessary. So with this integration happening, I think we should be very careful in terms of the sort of information that we are going to be putting up there. The second part is as it relates to control over integration. So I mentioned that since this is your accounting system, necessarily you have to integrate with other third-party providers or vendors. The implication of this is that there must be a due diligence that would be conducted in certifying that those third-party providers indeed at least have privacy compliance at the back of their operations. And another implication is that beyond that, the underlying contracts that will be executed between the vendors and then yourself must have adequate data protection provisions. So you must have access to audit. So I should be able to audit the system to the extent that that particular system is used for servicing my operations. I should also be able to have provisions on incident report requirements. That is very important. And I should also be able to have minimum security standard that particular organization must comply with. Now, for the company itself, what is also very important is that even as it relates to your system, you must put together adequate technical and organizational measures. So such measures may include your encryption, adequate authentication mechanism, system segmentation. So in other words, ensure that the particular module of your accounting system that deals with invoicing is isolated from other part of the system, such that in the event of a breach, it's just that aspect that will be affected and there will be no contagion effects to the other aspect of the system. Another thing that is also key is access control. You don't want to give people that necessarily don't have any cost to have access to the entire EPRO system access. Right? So access should be determined by purpose and then relevance. Another thing that is also important is when it comes to cross-border transaction and even data protection framework generally. The fact that this particular request is coming from the NRS does not exonerate any particular company from complying with data protection protocol. So the implication is that you would have to necessarily record your legal basis for processing in that particular manner. And that legal basis under the data protection law will be compliance with legal obligation. Beyond that, you need to map your data flow. So you will have what is not ordinarily called your ROPA, right? So your processing record that will allow you map your data flow from the point when the data is originated, from the point of transmission, from where the data will be stored, from any aspect of processing as the case may be. And beyond that, what is also very important is when it comes to cross-border. So let's say your accounting system is going to be archived maybe outside Nigeria, maybe the cloud services providers are outside Nigeria. The implication is that the cross-border aspect of data protection must be complied with. So you must have contract with the third-party access provider to ensure that at the very minimum, adequate protection when it comes to data protection and infused into that particular contract. And I can't even overemphasize training, which is very important.
Thank you very much. So in this 40 to 45 minutes that we've had to discuss, we've spoken a lot about the challenges that would possibly arise with this new system. We've spoken about how that could affect professional services, shipping, distressed companies, and privacy issues. But I think at the end of the day, one thing that we need to take home is there's definitely a need for training. There's definitely a need to understand the system. And please, I can't emphasize this enough, keep records. Because even when there are issues, if you as the one who, as the taxpayer, do not have evidence, not just from your internal processes, but you don't have evidence that the taxpayer can use to identify whether or not you were liable in the circumstances, it will be problematic, and you don't want your assets to turn into liabilities. Ladies and gentlemen, please give a round of applause to my esteemed panelists. Thank you very much. And thank you very much for listening.
Wow, thank you so much. Please, once again, let's put a round of applause for the panelists. I'm sure we have little presentation for each of the panelists. Please be seated. Panelists, be seated. Can I have Jegede bring out their... So, the representative of the president, I'm not sure if he stepped out. We'll do it there. So yes, we'll just be calling them one after the other. So we'll allow the two chairpersons. I don't know if I should call the, yes, let's ask Engineer Priska Kanebi to please step out, followed by the Maritime group chair, Mrs. Follow, down. Yes. So we'll have two of them present to them. Engineer Priska, I wanted to touch it very fast. So, Ma, where is she? Yes. So she will be here. We'll call the recipient who stays in the middle. Thank you. We'll give it to... Come again? Okay, questions. We'll deal with that during the B2B sessions. We'll have this for our partner Alukwan Oyebode, Shukuka Ikwazom, SAN. Let's put hands together for him. Please, yes. So move closer, man. While he stays in the middle to receive. In the middle, yes. Thank you, sir. Next, Celestina Nwabweze Eke, Managing Counsel, Olau Wumi Ajayi, LP. Let's put hands together for her. Olaniwu. Thank you, ma. In the middle, yes. Next. Dr. Emeka Akabogo, SAN. Let's put hands together for Dr. Emeka. I think he was not that represented last week. Thank you, sir. Director Shipping Development Nimasa, Mr. Abdullahi Sali, represented by Obaya Joshua. Let's put hands together for him, please. Is it over? Yes, yes, you'll be given. You'll be given. Managing consultant, Christian Padebo, Mr. Albert for long. Sure, let's put down together for him. Killian, yes, his name is Killian. Yes, family affairs. All right. Next is Mr. Olukule Ogunbamowo. Let's put down together for Mr. Kule. Thank you, sir.
Thank you so much.
Thank you. Are we good? For the final shot, please let's have all the recipients. Please hold on. In a group photograph with, yes. Please, can we please let's just join the two chairpersons in a group photograph. You can hold your plaques if you so desire. I mean.
Yes, sir. Mr. Dr.
You didn't come with your plaque. Jegede, can we create a space for, okay. Thank you so much. Thank you, sir. We can then return back to our various seats. I know this belongs to you, ma'am.
Yes,
thank you. Thank you, ma'am. Thank you. All right. Next item on our program for today, as we gradually call it a day, is the presentation of the new PPG executive, like Engineer Priska can be mentioned the other time, that I keep referring to her as outgoing. I think she's already going. Oh, she said, no, you have not gone. We have a new set of leadership at the PPG level. I believe these leaders will take the group positively forward. I'm very convinced. Having served or worked effectively with the ever-daring engineer Priska Kanebe, this new group will do more than what she had done. They will surpass her. That's the prayer of every parent. Please put your hands together for Kanebe and her team. So I'm supposed to call out the names while the leaders will stand right in the front. Then we have a vote of thanks by the new PPG chair. The new professional practice group, PPG. All right. The new chairperson is Ms. Taiwo Afonja. Please let's put her hands together as she comes out. Managing partner at Adekpetun. She will be serving as the chairperson of the group. Next to her, as the deputy chair, is Abimbola Oluokun. Am I correct? Abimbola Oluokun, principal partner, Abimbola Oluokun and Co. Chartered accountant. Is he in? Oh, now I know. Thank you. Thank you. Vice Chairman Programs will be Akim Olajide, CEO, Accenture Services Limited. Is he in? Let's put hands together for him, Mr. Akim Olajide. Okay, not around. All right. Vice Chairman Finance is Mr. Alex Ajibo, Managing Partner Alex Ajibo and Co. Let's put hands together for him too. All right. The secretary of the group is looking at me. I don't know why you have them on the list and they are not present. However, please put your hands together for Ms. Taiwo Afonja as she makes a vote of thanks on behalf of the new team. You want to come up? That's fine.
Good afternoon once again. I stand on all existing protocols, and it's with great pleasure that I stand here to give the vote of thanks for the informative and fantastic symposium by the Maritime and Professional Practice Groups of the LCCI, that is the Lagos Chamber of Commerce and Industry. On behalf of both groups, that is the Maritime Practice Group and the Professional Practice Group, I want to say a big thank you to the sponsors, Deloitte, to our esteemed panelists, and to our esteemed keynote speakers who have educated us today, who have delivered lectures and speeches that have given us a lot of information that will go back home, not just to think about, but practical, useful information to improve our businesses, which is what the LCCI and the PPG is all about. So I want to say a big thank you, and also want to say a big thank you to the outgoing chairman, Engineer Priska Kanebi. I think I got the pronunciation well. Thank you so much for your leadership of the group, and also to the outgoing ex who must have supported you for your tenure, and held up your hands in ensuring that the PPG moved to the level that it currently is at. I want to say a big thank you to them too. To the incoming EXCO, I have only Mr. Oluokun here. All the others are unavoidably absent, but I assure you that we are all working together for the success of the PPG, building on the success set by Engineer Priska Kanebi. We certainly will be working together to take the PPG to the next level, and ask that we all join hands to take the PPG to where we need to move to from here to the next level of success. I assure you of our dedication, our commitment, and our service to the cause of the PPG in specifically, and then in general, the LCCI. And we can only pray and do pray that, we would certainly at the end of our tenure record great successes for the PPG and the LCCI. Once again, thank you everybody. Good afternoon and enjoy the rest of your day. Thank you.
Thank you so much. Thank you so much for that short one. All right, on that note, I'd like to call it a day with a closing prayer, which is our national anthem. But just to mention that while the national anthem is ongoing, please be mindful of your personal belongings, your personal phones, and all that you ever came with. Then thereafter, after the national anthem, we will have B2B, where you can meet other fellows, other participants that have attended today, exchange cards and discuss businesses. Who knows? You may be sitting with a nephew or someone to a Milocon. I don't know, when we mention that name, everybody smiles. For me, the Emilocon means, something else to me, which it means business, really, to me. You can be sitting next to a Emilocon cousin or nephew who will help you connect to Abuja for what is necessary. On that note, please let's be upstanding for a closing prayer of national anthem. Thank you so much. I'm told we have, I think, refreshment. Please, let's be seated as they give us the refreshment. They have told me that if you are standing up, you will not be given. So, I don't know if I will be given because I'm standing up. But please, just be seated on your seat. You will get your own light refreshment, I'm told. Thank you so much.